All right, so I wanted to do an update to my Canadian stocks series that I do every now and then. I did do one somewhat recently. I don't remember exactly when. I should have looked before I did the video. But I think with the stock market being down so significantly in this past week, I wanted to do an update here because last time I did the video, I believe there was only one that I was actually eager to buy, which I already have a good size position in, so I wasn't necessarily buying. But if I did not have a position in any of them, I believe Go Easy was the only one, and that's the one I wanted to start with. First things first, if you get value out of the video, please like and subscribe. Check out the links below. Very much appreciate the support. So first one, like I mentioned, is Go Easy. This one definitely, I think, is, again, obviously do your own research, all that stuff. I'm not necessarily an expert. This is just my opinion. Their dividend is currently over 4% where they're at right now. They have an earnings yield of 11.5% based on where they're priced currently. So I very much think that they're a buy right now. They're actually 23% below their five-year average PE. Honestly, I think this one is quite undervalued right now. Whether it's 23% undervalued, I think that's debatable, but I think it's at least 10, 15, maybe 20% undervalued. So honestly, I would be buying it probably up until 160, 170, just going off the top of my head. Like I mentioned, 4% dividend on a company that's still growing very well. I mean, if we look at their financials here, going back about 10 years, they've grown revenue almost 17%, earnings about 28%. They have diluted a little bit, but their growth rate on their PE has actually gone down. So all of that growth has came organically. And then, I mean, their operating margins has came up, their return on equities came up, their net margin has came up. So I very much like those numbers. I mean, if we let's go back about 5 years just to compare growth. Revenue has actually grown faster, earnings has grown slower, but net margins came down a little bit, operating margin has came up, return on equities came down a little bit. So this company, they haven't grown quite as fast over the last 5 years as they have the last 10 years, but they've still grown very good. I mean, almost 17% earnings growth, 20% revenue growth. Those are still very respectable numbers. Like an 11 PE is still debatably cheap where it's currently based on how much it's grown. So a PE of about 10, I think it's probably 15% undervalued if I was just had to guess. So this is one that I definitely am buying where it's at right now. This is also one that insiders are very much heavily owned, 22% insider ownership. That's very good. So that's another thing I like to see. The next one is EQ Bank. Everyone who watches me regularly knows that I really like EQ Bank. I think they're undervalued where they're at right now as well. They have an earnings yield of about 11%, only about a 2.2% dividend yield, but they're growing it very, very fast. That's something that I very much like. This is a company that's beat the S&P 500 historically, so also very much like EQ Bank. They're growing very nicely as well. They've grown revenue almost 19% per year, earnings almost 12%. They are diluting, which I very much don't like to see, but I believe they have stopped doing that recently. Net margins actually came down a little bit. Return on equities came down a little bit, but they're still respectable numbers. So I still like EQ Bank where we're at right now. I've said time and time again that I think that probably a 110 to 120 share price is fair value. They are above their historical PE, but like I've said time and time again, you compare them to the bigger banks in Canada, they trade at a discount to all of them. And a lot of people would say, oh, well, they're not as established as them. But on the flip side, that means that they have more room to grow. And I mean, they have several advantages compared to some of these big banks. They also do have some disadvantages, to be fair, but I think that, you know, a 9 PE is still a discount. I think that they're worth 11, 12, maybe 13 PE. So I still think they're undervalued by a good amount as well. Alimentation Couche-Tard. This is one that's had some struggles recently, mainly I think due to a slowing economy. I think also due to their 7-Eleven potential acquisition kind of fell through. I think they're trying to still make it work, but that did kind of fall through. This is one that I don't think I would. I do have a position, but I don't think I would be buying because I still think that there's some weakness in this name, and I still think they have some room to go down. This is one that I would wait until we've reached like peak capitulation. Once the economy starts to improve, then I would be buying. But I still do think they're a good company. This is kind of one of those hold, not sell. I'm definitely not selling. I don't think that they're in that much trouble, but I don't think I would be eager to get into them, especially when I think that there's just better options. The next one is Constellation Software. This is one that I looked at recently after this week, and I'm like, man, I'm wondering how much it was down. It might be at a fair price finally, but no, it's actually basically just down ever so slightly on the year. So it's definitely still way too expensive where it's at right now. This is one of those companies you're just gonna have to watch. It honestly becomes cheap enough to buy maybe like every 5 years. If you look at their PE, the lowest their PE has got over the last 5 years is 56. I mean, even over the last 10 years, it's 34. So maybe every 10 years. So this is one that you're going to have to be really, really patient on because a 34 PE is still debatably expensive. They've grown earnings 20%, revenue about 20% per year over that time. So if they can continue to go that fast, they're definitely worth a 34 PE, but they're definitely not worth a 90 PE. That's just way too expensive. So this is one you're just going to have to be patient on. It's way too expensive where it's at right now. It is a phenomenal company, so it deserves to trade at a premium. I just think that a 90 PE is just way, way too expensive. So you're going to have to just watch for this one. Loblaws is the next one here. This is one that I definitely do like. They're still too expensive where they're at right now. They're not actually down really at all. They're actually basically very close to an all-time high. So this is one that's definitely escaped the tariff threat. I mean, for the frank reason that, I mean, it's a Canadian-only company, so it's not really going to have much of an effect there. The one thing that I would be concerned about for them is a potential slowing economy, but they're a company that doesn't necessarily cater towards the higher end consumers in the first place, so I don't think that a recession would hit them that hard, but it definitely would hit them. So they've grown earnings 16% per year, revenue 6%. But, I mean, they trade at a 26, almost a 27 PE. The average is about 25.5. But I still think they're too expensive where they're at right now. I mean, the lowest they've been over the last 5 years is about 16.5. I definitely would be buying them then. But, I mean, for a company that's growing earnings 23% per year, they probably deserve, a 20 to a 25 PE. I just think 26 is too expensive. I would be waiting for probably a 10 to 15% pullback on this company before I would start to buy. They are buying back shares very, very aggressively, though. They're growing their dividend nicely. So I definitely think they're a very good company. They're just too expensive still where they are at right now. Another one I've never talked about before, Stantec. This is another one. I think they're still too expensive. They've kind of thwarted off any tariff threats. They're actually up on the year. I still think they're too expensive where they're at right now, but I do think they're one of the better Canadian companies out there. I mean, they've grown earnings 19%, revenue 14%, shares outstanding up ever so slightly, but return on equity's gone up nicely. A lot of their gains have came from people simply paying more for their earnings. Their PE is at a 29. The lowest it's been over the last 5 years is about a 21. They're definitely too expensive where they're at right now. They'd have to come down probably 15 or 20% before I would buy them. But I do have them on a watch list. I do think that they're one of the better Canadian companies out there. The next one is Olympia Financial. This is one I just put out a video on, so I'm just briefly going to get into them. They've also done quite nicely this year. They're down slightly on the year, but 4%. I mean, the S&P is down like 15 roughly, I think. They're paying almost a 7% dividend. The earnings yield's 9.5%, so they can pay that easily. They're a company that has very, very high insider ownership, about 35%. So I really, really like that. The one, honestly, the biggest concern for me with this company is they're a very small cap company, only 250 million. So these kind of companies, especially on the Canadian markets, come with a lot of risk. And I mean, I was trying to buy a little bit this week, and the volume is very, very low on this company. So you have to be extremely patient. I mean, unless you want to do market orders, but market orders on a company that's this small, you're going to get filled at some pretty bad prices. So you just have to be patient if you do want to buy them. But again, keep in mind that it does come with a lot of risk. But again, they've done very, very well. They've grown earnings at 23% over the last 5 years, revenue about 16.5%. And their compounded annual growth rate to their PE has gone down. So all of the returns that they've had over the last 5 years have been from organic growth. The operating margin's up nicely, the net margin's up nicely, and they haven't even issued any shares. The shares outstanding is flat. Return on equity has gone up. So I really, really like this company. I think that they're definitely worth the gamble, but I am keeping them as a small percentage. I'm definitely not going, any more than a couple of percent, at least for me. But I very much do like them. If you look at their PE, it's around 11, just under 11, and their 5-year average is about 12.5. So frankly, I do think they're undervalued. Like if they're growing this fast, frankly, they should have definitely a higher PE, probably not a market average PE, but given how small they are. But I think that they probably command, a 13, 14, 15 PE. So they're definitely undervalued in my opinion. But again, they do come with a lot of risk. Another one that is one that I've never talked about before here. This is a very small cap gold, and I believe they produce silver and some other stuff. DNG is the ticker symbol. So they're a mining company. They produce gold, silver, copper. Basically gold, silver, and copper. Again, another small cap company, about $200 million. They're basically at a 52-week low, which is kind of strange considering gold is basically at an all-time high. But they do have a pretty good copper and silver aspect of their company. Again, they're a very small cap company, but I really do like them. This is another one that I think is worth taking a risk on. They do have a pretty good size in insider ownership, about 7%. That's not as high as I would like it, but it is still pretty high. The dividend yield is about 3.6%. The payout ratio is only about 30%, so they do have a lot of room to grow that dividend. They've grown that dividend very, very nicely. I mean, look at that dividend growth. They have beat the S&P over the last 5 years as well, which I also like. If we look at their financials here, revenue's gone up 22%, earnings has gone up 22%, shares outstanding are actually down slightly. The net margin's up slightly, the operating margin's down slightly. Price to earnings actually came up quite a bit. Return on equity, they've grown quite nicely. The average PE over the last 5 years is about 8.1. They're currently at about 8.7. So I definitely think they're a buy where they're at right now, given how high gold prices are right now. But this is one of those that I would say maybe it's worth a 10 PE. So I think they're undervalued, but they're not undervalued by that much, just a little bit. But I mean, they're very look at these numbers. I mean, analysts are very bullish. The current ratio is almost 4, which is very good. This is another thing that's very important with a lot of these smaller companies is that you don't want companies that have a lot of debt, because if things go sideways and they have a lot of debt, that could easily mean they go bankrupt. And this is another thing about Olympia Financial that I didn't bring up as well, is that I believe their current ratio is actually even better. So that's another thing to look out for, is you want companies that do not have a lot of debt, because if we go into recession with higher rates, that's something you just don't want to mess around with, because it's just an added layer of risk that's just not worth it. The next one and the last one I wanted to talk about is CNQ, and they've gotten hit really hard because oil is down a lot recently. I mean, they're down about 12-13% in the last week, which is more than the market is. I like them where they're at right now, though. Their current dividend yield's about 6%. The earnings yield's about 7%. So they're definitely, up against it a little bit there. But this is one of the best oil and gas companies out there, in my opinion. They've grown. I mean, they've grown earnings 17% over the last 5 years or so. Revenue about 13%. Return on equity has gone up nicely. Operating margins up. Net margins up. Shares outstanding have gone down. If you look at their average PE, I mean, it's been about 52. They're currently at about 15. They did go negative briefly back in 2020. I mean, let's go after that just to see. I mean, the lowest they've been over the last, let's say 4 years has been about 6. The highest they've been is, well, actually, it's been about 15. So their PE is actually about as high as it's been, but I'm not concerned about that because I think this is one of the best oil and gas companies out there. Obviously, when you have recession fears, they're going to sell off. But at the end of the day, I still think we have structural shortages of oil, which over the long run is going to mean higher prices, which is going to mean higher prices for companies like this. So I am a buyer of them right now, but I'm not necessarily taking on a huge position. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, check out those links below, and stay tuned for more.